Hello everyone, my name is Hoda Mehr. I am founder and CEO of Stoffel. And today we want to talk about Unity software, ticker U. The reason I want to talk about it is that a lot of my favorite investors and thinkers on Twitter or YouTube, people that I follow, have started selling their shares of Unity software after the company's recent quarterly earnings report. I'm a shareholder directly and through my ownership of ARK Invest flagship ETF. So I want to know whether I have to sell my shares too, or there are reasons to hold on to our shares. Certainly the stock price has been increasing past the quarterly earnings report. And even today, as I'm recording this episode for you, the stock is up 10% or more. So what's going on and what are we going to do with our stocks is today's focus. As usual, I'll use the 7-part framework for evaluating 100 bagger stocks. This framework, if you're not familiar with it, I've talked about this in the previous episodes of the 100 bagger series. I put a link to them to go and have a look. But today we're going to jump into Unity software. Let's get to it. From our 7-part 100 bagger framework, the first 4 things we want to look at is the company's market cap, the company's revenue growth, the company's profitability or earnings power, and the company's free cash flow. So let's look up Unity Software as a stock card and answer those 4 things that we just talked about. The first one in our list is the company's market cap. Unity Software is almost a $10 billion company at this point. In order for it to generate a 100x return for us, it needs to become an almost $1 trillion company, a $1 trillion company. It may be or may not be possible. Certainly last year during COVID, we've seen some of the biggest companies in the technology sector, Amazon and Apple and Facebook, Meta platform, they become $1 trillion companies. But since then, a lot of them have actually fallen from the grace. So getting to a $1 trillion company market cap, it's a very difficult task to do. So we may or may not get with Unity Software. A good test to do that is that the company's primary competitor is a platform that is owned by Epic Games. It's an engine called Unreal Engine that users, game developers can use to create beautiful and really high fidelity visuals and sceneries and characters in their game environments or in other 3D virtual environments. And that company, that Unreal Engine is owned by Epic Games, if I'm not mistaken, and Epic Games is owned by Tencent, another player in the market that we're very familiar with. And Tencent Holdings market cap as of now, it's a $320 billion company. So of course, when we talk about 100x return, we're not talking about getting to 100x return now, and this is all forward looking, but it would be interesting to have this in our point of view that for a company to become a $1 trillion needs to grow significantly, and its competitor like Tencent, who has a lot of other businesses beyond the Unreal Engine, it's only a $320 billion market. So to me, that market size right off the bat, it's a barrier for it to become a 100 bagger. It can become a much bigger company, but a 100x return probably not possible. The second criteria that we want to talk about in our framework is the company's revenue growth. Revenue growth is part of the financial information that is available in company's income statement, and the stock card automatically pulls that information from company's annual and quarterly statements. So revenue, based on 6 different analysis for Unity Software, seems to be doing quite well. The company does about $1.1 billion in revenue in the last fiscal year, and the latest quarterly earnings that we just passed, they reported $322 million in revenue. That gives Unity a basically a quarterly revenue growth of 8.7. On an annual basis, if you look at it, actually the company reported a 13% revenue growth in its top line. So Unity Software does grow pretty steadily in the last quarter, in the last annual year, on a year over year, and even on a 3-year revenue growth base. It would be interesting to compare that revenue growth with the overall market's growth rate. So Unity's most important basically market that we can compare its growth rate with, it's basically virtual reality content creation, augmented reality content creation, and video game industry as a whole. And so it's somewhere between 13%, 12.9% to 46%, 76%. These are very rapidly growing markets that Unity is operating in. So a 13% revenue growth rate on a quarterly basis or 40% revenue growth rate on an annual basis, it's a formidable growth rate. But one thing we have to consider that it's one of the reasons that those investors that I was telling you about, who I follow, are selling their stocks of Unity Software, is that the company has recently just done 2 big acquisitions. One acquisition is done and closed earlier in the year, and it was in the content creation side of the platform, that basically the create side of their system and their products. And then recently they just closed acquisition of ironSource. And ironSource was a publicly traded company that now sort of merged with Unity. And this company's business is focused on the other side of the Unity Software's product, which is on user acquisition and monetization aspect of games and virtual experiences. So the reason I brought these 2 acquisitions into our discussion is that, yes, 13% quarter over quarter growth, and then we saw 40% year over year growth rate in their revenue, but those numbers are the combined effect of merged and acquired companies with Unity. And it's interesting because management doesn't provide any distinction between what is their growth rate organically and what is the growth rate that is coming from those acquisitions and mergers. And when the companies don't say these things, it means that it's not a good news. Most likely, most of the growth that is coming from their revenue, it's coming inorganically through those acquisitions. Those are not bad things. It just means the core business is not as strong as what the management really hope for, and we really need to be mindful of that fact. The 2 other financial information that we would want to pay attention to when we're evaluating Unity Software or any other company that is on our radar. It's the company's profitability and the company's basically ability to generate free cash flow. Profitability is where things fall short for Unity Software. The company isn't profitable from a net income point of view. Like at the end of its but at the end of the day, in its bank account, when it takes all of its operating expenses and cost of delivering its products and services, the company basically generates minus 21% in operating income. Oh, this is an operating income growth, but the company basically generates negative net income and negative EBITDA at the end of the day. So that's a concern. If you were a business that you have to grow through acquisition, and you have to grow through mergers, through inorganic ways of growth, you really want to be profitable, because those are 2 ways that stock market value your company. You either bring very, very aggressive top line growth rate, or you show that you have found a way to transfer whatever growth that you're creating, whatever small amount of growth you're creating on top line, into profitable operations at the end of the day. And this needs to be a very important or big focus for Unity Software. The other financial information that we would want to pay attention to is the company's free cash flow. For free cash flow, it means after you pay for everything, you pay for your operations and also you pay for your capital expenditures, what's left for the company, for shareholders, in order to reinvest in its business. And that's unfortunately also, it's negative. It's a negative $80 million in the last fiscal quarter. And if you look at it in the last year and 2 years ago and 3 fiscal years ago, it's all negative numbers. These are not very good signs for Unity software. I have to say, as a shareholder of the company, when I really invested early on when the company became a publicly traded company. It was in a much better place in terms of revenue growth. It wasn't profitable. It wasn't generating free cash flow, but that top line revenue growth was growing really rapidly. And that was something that I was very excited about, considering what's happening in the market for gaming and virtual world and experience development. So that was my original justification. But now I don't see that top line growth. So I'm looking for that profitability and I don't see it and I don't really like it. So let's just recap the 4 things we looked at together. The company's size, already $10 billion. It's very difficult to assume it can become $1 trillion if you're going after 100x return. Revenue growth is good and solid, but we saw it's almost similar to the video game industry, and it's not as fast as what we want to see in some of the more aggressively and rapidly growing companies out there. It is not generating earnings, and there is basically spending significant amount of money in their operations, and that's not a good sign. Free cash flow is negative, and that's not a really good sign either. I didn't write a note here that yes, it doesn't have free cash flow and it doesn't generate any earnings, but we have to be happy that the company still has $1.2 billion in cash in its balance sheet. And we can see that on companies, the stock card, if we go to its cash and debt section of the financial strengths. And if I click here, we can see that actually the company has almost $2 billion in cash and cash equivalent in its at the end of the last quarter, which was ended in September 30th. So it is cash rich, a company. It's just not profitable. And if it can find a way to generate free cash flow or become profitable, this cash that they have on their balance sheet is going to get consumed quite rapidly. And so that's why it's important to pay attention to those financial information. Now let's go and talk about the last 3 part of the 7-part framework to evaluate a company's 100-bagger status. The last 3 part is about evaluation, the leadership quality, and the competitive advantage or moat of the company. So I'm telling you, stay tuned for a second, because the part that's going to be worrisome, and it's worrisome for some of the good investors that I follow, is the leadership problem. So we're going to talk about leadership problem in a second. But before that, let's jump into the valuation of the company. And it's the stock card. Now, there is a valuation section for every publicly traded company based on common multiples like price to earnings, price to sales, price to book value, that kind of valuation metrics that we all look for. So let's go to that valuation section. Too fast. Here we go. Doesn't have any earnings, so there's no price to earnings ratio, obviously. And the one criteria that we can rely on is the price to sales ratio, and Unity has almost an 8x in terms of price to sales ratio. It is pretty expensive when you compare to average market of 3 times, 2.5 times, but it just tells us that the analysts are quite excited about the future growth potential of the company, and that's why they're basically pricing at least 8 times or almost 8 times growth rate in the company's revenue. So we can't really say we're buying this stock at a really, really good valuation, but it's also not as crazy expensive. Now we get to the part that is worrisome to a lot of investors that I follow and know, and that's basically the company's leadership. So I looked at the company's leadership. The CEO, it's a veteran in the gaming industry. He has brought a lot of veterans from the gaming industry to his command as leadership team. He has been around for more than 8 years in the company, and he has 2% ownership. So if you look at things like ownership, basically having a skin in the game and having a good team around the CEO gets a big thumbs up. But it's time to basically switch to some of the reasons by one of my favorite investors that I follow on Twitter, who happened to be a Stockard partner as well, Brian Estofo, who did a really good analysis on Unity software a few days ago. And based on that analysis, he decided to sell his Unity shares. And I really think what he brought up from trusting the management is worth paying attention to. So Brian basically talks about some of the sexual harassment allegations around and about the CEO of the company, which of course is something that we all knew before even investing in Unity software, but it could basically talk to the CEO's ethical values and things like that. The other thing that he's pretty worried about, which is a decision by the management, is the dilution that is possible. So the management of the company have decided to issue significant amount of stock-based compensation, basically issuing new shares and grant those options to own shares of the company in the future to the employees of the company. And that means when these option grants, stock-based option grants, come due, and they will be issued as shares in the company, and that would dilute the existing shareholders. So he doesn't trust the management because he made the decision, or as a management team, they made a decision to issue such a high amount of stock-based compensation. And the other thing that really was worrisome to Brian, that I would actually agree with him, is that management sort of like dodge the questions that come from analysts. And these questions are about the distribution of the revenue growth rate from organic sources, which is the actual product and services that Unity offers, and the result of the mergers and acquisitions that they've done. I was actually quite concerned about that as well. And I will listen to the management conversation in the last earnings result. I was very surprised that they're basically dodging the question and they don't answer that question. It tells us the management is not as transparent as they should be. And really, when you have a significant amount of money in a company, you really want the management to be transparent and basically provide, even if it's not good news, they should provide some guidance and shed some light on what's coming from organic and what comes from acquisition. At the end of the day, investors know that you make the acquisition to grow the company. So even if the growth of the revenue is coming through acquisitions and mergers, we all expect that. But when you dodge the question, that basically creates distrust between investors and managements. So if you haven't read this thread by Brian Stoffel, I put a link to it in the show notes, and I highly recommend you go and read it. I gave the management a thumbs up in my analysis based on those skin in the game, leadership, team quality, and sort of like their ability to run the company in the past 8 years. But there is a consideration of issues of trust that Brian Stoffel just brought up in his thread. So pay attention to that. And we're down to the last criteria, and that's about competitive advantage and a moat of the company. So here, The company Unity has a really, really good brand. We know it's basically part of this duopoly between Unreal Engine, which we talked about, it owned by Epic Games, and then Epic Games is owned by Tencent, and the basically the engine, the solution that Unity software offers. And so that is in gaming industry. But beyond gaming industry, as they grow their business, we recently know that, for example, one of the shows on HBO is using Unity software to create their virtual environments and sceneries. And those are really good sign. But Unity really needs to work hard in order to establish its brand in those beyond gaming industries. So it doesn't really have that strong of a brand in other segments of the market. And of course, in the acquisition and monetization, which is why they acquired ironSource, they're not the only game in the town. And then the other last thing is the sort of the margin of the company. I really always look at the company's gross margin as a way to evaluate how cost effective or low cost is the operation of the companies that I'm investing in. And if I go to the margin section of Unity's stock card, it basically gives us a gross profit margin of 65% in the last quarter and 77% in the last annual year. So those are good margin, but it's basically moving down, right? 77 in the last year, fiscal year, and then 65% in the latest quarter. So the margin is solid in terms of cost effectiveness of their delivering their products and services to their customers, but it's moving towards downward direction. So that's a concern, and sort of gives you a little bit of a pause in terms of whether the company's moat in the industry is getting stronger or whether they're actually losing their moat in the industry. So there you have it. We have a lot of red, unfortunately, in Unity Software's evaluation, and we have a few greens, but even the greens that we have here in terms of management, other people have very strong arguments against it. So overall, Unity Software is not faring well against the framework that we typically use. I do want to talk about Rule 200. And Rule 200 is a rule typically used by venture capitalists to evaluate the growth potential of their companies that they're investing over the course of long term. And it's basically a score that comes from the combining operating margin, gross margin, revenue growth, and 12 months retention rate of revenue for that company. And if all of these together become more than 200%, that's a really good sign. Unfortunately, for Unity, we don't get that good number we're looking for. Operating margin of minus 74, gross margin of 65. This is the last quarter. And then revenue growth of 13%. This is last quarter. And the part that really bothersome is this retention rate of 111%, which is not bad. It's actually, in isolation, it's a good number, but it is coming down from a revenue retention rate of 142%. So from 142% to 111, put all this together, and Unity Software gets 104. So it is really off from that 200% score that we look for because basically, the company has really bad operating margin. This is the minus 74, and its net retention revenue retention is basically going down. So yet again, another bad sign in Unity Software's operations and what they're doing for their shareholders. So why I'm not selling? I haven't yet sold my shares. I still own my shares. And despite I see some of the investors that I trust have sold their shares, I'm still holding on. The answer to that question comes after this very good news from Stockcard. So if you don't know, we are a finalist on Benzinga's Best Investment Tech FinTech Award for 2022. We were a finalist. The results are to come in on December 8th. Fingers are crossed. We really want to win and to have that top of the ladder spot in the investment tech category. But even if that doesn't happen, but hopefully it will, we're very happy for this nomination and being a finalist. And on that note, if you want to support us, or if you believe in our mission and our product and what we deliver to retail investors like you and I, please consider investing in StockCard. We're running a public crowdfunding on republic.com. So republic.com/StockCard. And you could join these existing 42 investors in our company and become 43rd investor, 44th or 45th, and hopefully hundreds investors in our company. And we really have big dreams for the future of retail investing and enabling retail investors to become the best investors they can be for their own personal portfolios and assets. So now that we talked about StockCard, let's go back to my reasons for not selling. I hope the company's valuation be higher than what it is right now. And even if I decide to sell, I can sell it at a higher valuation. And why I believe that's possible is because valuation can only come from two sources. It can come from sales growth, or it can come from higher multiples. So Unity has been growing 13%. It's basically sort of aligned with the industry's revenue growth rate, in the gaming industry's revenue growth rate. But what is interesting is that the 13%, regardless of it is coming from inorganic growth rate like acquisitions and mergers, it's happening at the time that the one side of the business, which is the advertising and monetization side of the business, is really going through this down cycle. So I really believe the market can recover in the next few quarters. The advertising dollars are going to come back. We've seen it come back in other cycles in the past, so it will come back. And just by the nature of growth in the industry, Unity Software is going to be able to have faster growth rate. And then in terms of the multiple, they're not profitable right now. They've recognized that in the quarterly earnings report, and they basically promised transition to profitability in the next few quarters. And if I want to even give the management one last test to evaluate that they can deliver and execute against their own plan, is their ability to become profitable. And if they become profitable, they're going to get higher valuation. The market's going to like them more. And then the other one is the price to sales ratio. So the price to sales ratio of 7x that we talked about when we were looking at the valuation, it can still be higher. We have seen higher price to sales ratios, especially if the company becomes growing faster. The advertising dollars come back to the overall market, and the company shows a few quarters of rapid growth rates in their sales and their revenue. It can get higher valuations. These are all bets. I could be very, very wrong, and I could lose my opportunity to get rid of my Unity shares at this point at a sort of a good price, but it's still at a significant loss compared to what I paid right after the IPO. But I want to give the company another test at least, or another quarter or so to basically prove themselves. But also I want to give the market a chance to recover. I really don't like selling at the peak of negative sentiment, which where we are in the overall market, and I think I could get a higher valuation for it. So those are my reasons for not selling at this point. And if you are holding, let's just recap a few things that we want to watch for. We obviously want to watch whether the company can improve that revenue retention rate of 111% back to 140, 150% that it used to be. We really want to see whether the company can manage its cost and basically not to have that significant growth rate in its operating costs and capital expenditures. We really want to see the ad market to come back. That's quite important because that's one of the most important reasons we're not selling. And we want the management to prove themselves and tell us that we can trust them. And while they kind of hold back on some of the information that they can share with us, we really want to see that as for good cause, and because they're working on a lot of interesting and internal projects and they want to surprise investors in the next few quarters. So those are the 4 things we're going to watch for in the coming quarters. I hope you enjoyed it. And if you enjoyed this analysis, please like and subscribe to the channel. That's how YouTube algorithm works. And if your YouTube algorithm recognizes us as a content that investors like you and I want to watch, they will spread the word faster, and we all become a better investor managing their own portfolios. Thank you very much for supporting us, for liking and subscribing. I will see you in the next episode. Bye.